just go over the notes again and not take too long with it because you've all, but let's just go over it again because, what is it? What are you trying to accomplish, right? And so, you take your capital and you multiply it by the law of large numbers, which is essentially what we're saying is you take your capital and you flex it on a ton of positions, and the end result is going to be, let's double click there, the expectation. So we take your capital, we multiply it by some probabilities in a large way, right? So we create a big sampling, and that's why, I like to have 50 positions at one time, because then you get your expectation, and you have all kinds of things that go wrong, and then you have other things that go very right, and they all negate each other, and in the end, you get your expectation. In a general sense, that's what you're doing here. So what is the expectation? The expectation is 12.8% return on capital per month, which is amazing. Now, my return on capital has shifted in the last month because we had the market sort of crap out on us. So that may be down to 9 or 8% per month. But either way, you could say that during times in which performance is moving right along, that you would expect 12.8% return on capital in a month's time. Hey, Ben, there you go. Welcome in. So 12.8% return on capital per month is the expectation there. Now, we target the picks, the opportunities, tickers, the picks, the stocks are growth stocks, pretty much primarily. I'm not finding, and I'm looking hard, but I'm not finding any value stocks providing the right number. So growth stocks would be, yeah, on a chart, something that's up more than 20% in 1 to 6 months. And if you look at the chart, could kind of consistently, like a beautiful uptrend would be great. So 20% kind of the minimum in 6 months. That's slow even. But so some of these they do 40% in a month, or 100% in 3 months, stuff like that. But you're looking for charts that are going up and up and up, okay? Stocks that are going up and up and up and up, and they should be names, not penny stocks. You can find penny stocks going up and up and up and up, and they'd be a horrible, very high risk thing to get into. That would not be a good idea. Let me clear this up. Jeez. All right. Then the entry rules. Entry. You want to size 2% of your port per position to get 50 positions going. Entry criteria also is, let's put these down. There we go. Put that there. 20. We're trying to get 20-ish delta. Put credit spreads ideally, but they can be called credit spreads. But 95% of the system is put credit spreads. And if that's all you did, 100% of it, if that's all you did, that'd be fine too. You're looking for 20-ish delta put credit spreads, 45 DTE, and they need to be liquid. That's, there's a lot of packed information to that. Liquid, there's a lot there. The bid-ask spread, the volume, the open interest, all that. So I could put that here. OI, the bid-ask spread, which is not related to the word spread in spread trading. Bid-ask spread, it's a different spread. Open interest, bid-ask spread, volume, etc. on that particular strike or option. Okay, and then now management. So you have to, so those are like opening rules, closing rules, exits. And for exit, you want to exit at plus 50% max profit. I forgot there's another criteria here. We're in entry. Size, delta, 45 DT, liquid, and we want the ROC to be greater than or equal to the delta. Everybody understand what that means? So if you're getting a 21 delta spread, selling a 21 delta spread, you want to have at least 21% return on capital when you do the computation of how much you'd be getting in credit versus how much you have to put up as collateral. Divide those together and you get, hopefully at least 21%. I find and like and search for and try to get something more like 25% or more for a 20 delta. So like a bump up, you know. Okay, so that's part of the entry criteria. Let's move this now. Now the exit criteria includes taking a profit at plus 50% max profit. That means 50% of the expected calculated return that you figured out when you got in. That's different than shares trading. So it's very interesting. It's a different way of running trades. So 50% max profit. The other time would be something called accelerated gains. Why do I capitalize some things but not others? That pisses me off. Accelerated gains. Um, um, I have the others in mind, but I was thinking of something else that's in between accelerated gains. Okay, well, 21 DTE. Okay, now those are like all the positives. That's like, well, not necessarily. Accelerated gains and 50% max profit. Those are both positives. 21 DTE might be a positive. It might also be closing out a negative. Minus 100% of max profit. We're going to just call that MP after that. So I guess I'll define that over here. Minus 100% max profit. I feel like there might be something else. Oh, yes, a breach. Let me know if you don't know what breach is, and I'll explain it. Exit. Now I'm trying to think if there's any other subtleties I may have missed here. Also exit prior to catalysts. That means ER, for example. So now, if you were to just copy and paste that, what I just put on the screen, and follow it, you'd be like 95% on your way. That's it. It's so, I know it seems like a lot of moving parts when you compare it to shares trading, where you just go like, hey, I want Amazon, give me, $450 at Amazon or $5,000 at Amazon, whatever it is, right? And you click buy and then floop, there you go. And now you just sort of hold and wait and like, ooh, things look good. I'll take a little off or take some. That just seems so easy. And I know that's easy, but it's not so easy to actually make work repeatedly over and over, is it? Now, this has a lot of moving parts. I understand that. And there's a lot to understand. But once you get over that point where you think you've got it and you start to try it, yeah, that's gonna be huge. And it's not a lot of stuff to really get a grasp on. That's it, like right there. Boom. Now, outside of all that, that's amazing in and of itself. You have to realize that. Like, right, you're staring at an incredible capital investment management trading system. Right there, that's it. And it's pretty simple. It's not a bunch of stuff and even subjective. Now, when you get good, you can introduce subjectivity and start to make subjective decisions, and that's perfectly fine. Like other system traders or even algorithm traders or bot programmers and those kinds of people will tell you, oh no, 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 no subjectivity. We don't want any, differential coming from a human because the system is the system, and we've back tested this and this is the result based on the back test. Well, I can tell you the back tests can be flawed. And by the way, there may have been spots in the back test where things could have done better. And a good human trader can potentially get to the point where they can make those better decisions. And what I'm referring to is like, for example, at 50% max profit, what if one day you're at 57% max profit and that's triggering the rule, and so you have the choice to either close that out right then, and it would be correct. Systematically, that would be correct, and it probably would be great, and that decision works. However, you could also just wait till the end of the day, which is almost always good advice with this system. Wait to the end of the day, towards the last hour, or 30 minutes, or even 10 minutes to make your final decision. And let's say it's at 57% or whatnot. It depends on how the chart looks on the daily and how it's formed, but you may make the subjective decision. Maybe everything's just going great and there's just no reason to think the market would go anywhere, let alone this stock. So you hold it overnight. Well, if you make that decision with a heavy seriousness about overriding the rule, it's probably because not because you're being stupid and greedy. It's probably because you found every right and reason to stay in another day. And the next day comes and now all of a sudden you're up 73%. So just because it says exit at 50% max profit doesn't mean you exit at 50% max profit. Like, you'll get more, and as you get better, you'll be able to you know, play with it a little bit. Like, I have a position, for example, I have DJT, Donald J. Trump stock, DJT, and it's up 100%. It's already at 100% max profit. It says 98.5%. So obviously I held that beyond 50% max profit, but there was very interesting reasons why. And I've got another one, Kava, which is at 78%. And I got Robinhood at 67%. So a bunch of those are past 50%. And why am I still holding them? Um, well, like for example, look at Kava. Watch behind all these words, you'll see it over here. So I'm in no danger. It's it took way off. I'm in no real sensible danger There's been no really bad days along there except for that one. And I think I wasn't around for that and came back and I was like, oh shit. And the next day it went back up and we were back in the swing of things. And these things happen. But here I am sitting on 78% max profit on this move. And tomorrow it'll probably be at 83%, each passing day where it hangs out in this area. And I have the orders in. And if they fill, then there we go. It's closed out. But yeah, so you have a lot of situations where you can make exceptions. So that's the quick overview of the spread trading system. I'm going to call that the max profit max profit system, something like that. Max because it's all about that whole technique with max profit. It makes sense. And I bought maxprofittrading.com. And but anyway, the whole max profit sort of branding, I think, we can call this the max profit system. So we'll refer to it as that, the MPS, the max profit system, or MP. Colby has a question. What do we got here? What would you consider minimum for open positions for this to function as designed? Would 50, what would you consider minimum open positions for this to function as designed? Would 50 be the long-term target, or can you manage a functioning spread at say 20? Can you manage the functioning spreads at say 20 or even smaller when getting into it? And do you ever have a hard time getting a full 50 positions up and running? Super great question. And this is exactly kind of like what I wanted to do. Wanted to talk about sort of the philosophical backup. Let's talk about the bigger picture about this whole system. Questions. Perfect question. So 50 is the long-term target. 50 is what you want. Like you don't not want 50. You want to do whatever you can to get, it can be your long-term target to get to where you can do 50. And I don't mean like to where you're seasoned and athletically ready or whatever it is to manage 50. I mean, if you can do 50, even if you're not good at it, you should do 50. You'll find it's not as daunting as it sounds. 50 freaking shares positions would be a nightmare and would kill you. Not because of the number of positions. I'm saying it would kill your capital because any kind of terrible move in the market, you get hardcore slammed by that. This doesn't happen so much on the PCS stuff. So anyway, whatever you can do to get to the point where you can set up 50 positions, you should be working towards that for sure. And if you can do it, not if you can manage it, but if it's possible, then you should do it. Like even if you can only manage 10 positions, you should make those 10 positions small enough as part of the 50 positions you could have had that you could have 50 positions. So in other words, let's say you're saying to yourself, I can only manage 10 positions or 20, let's call it 20. But you have enough money. Let's say you have, let's say the average contract size is like $400 times 50. So 20 grand is all you would really need to do like one contract on average between $100 contract, between a $400 contract, between an $800 contract. On average, $20,000 would be enough for you to get 50 positions going. That's, I think, $500 per position, $400 per position. If you have that much, I'm saying, and you're worried about that's going to be too much to manage, still size the 10 or 20 positions that you get into such that they fit in a total that you could have had 50 positions on the $20,000. And the reason for that is because you'll thank me later, but I think you'll find that once you have 10 on or once you have 20 on, if you had the room and you sized them like I just said, and you could have had 50, you might find you're doing nothing. for days. And then you just like, why don't I just put a few more positions on? And now you'll be at 25 or 30. And even if you don't get to 50, just to have that there, to understand the sizing, to get the math right, to get the math going right between dividing your port by 50 and using 2% like that, as your size. Uh, I think that's really good. So it's a great question, like a super great question. Now, that said, if for some reason you really do want to cap your law of large numbers at 20, which is going to subject you to a greater degree of potential bad periods. You get the variance could hit you. Uh, you could get into you could have a bad run. You're much more likely to have a bad run at some point. Like it might not be you. Like if I was teaching like a seminar of 50 people in the audience, I could tell the whole audience on a whole that if they do 20, I don't recommend doing 20 positions, because if they do 20 positions, they run the risk, they run a higher risk of having a very bad run happen. And what's going to happen is actually the majority of people in that audience, if they all did that 20 positions and they tried to test me, the majority of the audience would not have that experience. They would all have a good experience. But a minority of the audience would have a bad experience, and probably a very small minority, one or two or three of them, would have an absolutely terrible experience. And so the problem with that is, do you really want to run the risk of that being you when you can just eliminate that risk by pressing a much larger law of large numbers, a larger statistical sampling by going 25, 30, 35, trying to push your limits a little bit. So I just like absolutely recommend going 50 positions. But if you can't do it, like for example, you don't have enough capital, let's say you only have 4 grand, you might only be able to do 10 positions on $400. And, you'd probably be uh, risking a lot by doing that, because the bumps in the road are going to be quite bouncy. In fact, I kind of don't even recommend that size. That's a little big. 10 positions means, I think, yeah, 10% size per position. That's quite big. Now, chances are greater that things will be fine than that they would be worse, and you might do quite well. Right, the athleticism thing. Like I don't know the word for what we're talking about, but yeah. But with practice, I won't sweat it. I really think not. And I think when you have 20 positions, you'll notice that. Um, and that's what's great about Randy Winkler. Randy. Oh no, he's not here. He's recording. Uh, is he went for it? And even when he went for it, like he tried to go gung ho. No, I did gung ho. he he tried to inch his way into the waters. It's like becoming a scuba diver or something. He's starting in the shallow end. Um, and he went for it, and he got in 16 positions, and so that's a lot, right? It doesn't sound like a lot though compared to 50, but 16 is a lot, and it does sound like a lot. And it was so good for him because you're going to learn so much faster too. Like if you just use a paper trading account and you get 20, 30, 40 positions going, the speed at which you're going to make mistakes and improve and get better and double check this and double check that and make sure of this and make sure of that, and then just start honing it down to where it's like it's exactly correct every time. Boom, 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 boom. You're going to get there a lot sooner. Like you might get there in 2 months versus 8 months, by using doing a lot of positions. So there's kind of quite a few reasons why. So, but I found when I have right now I have like 33 positions, I think. I found when I have like 50 positions on, I'm dealing with 1 to 5 positions per day. It's not that bad. That's with 50 positions. I have 33 positions on right now, And with regards to positions that I have, I had to do, let's see, I had some filled orders today. Look at that. Two. I only did two orders today to existing positions. I opened up one, two, three, four, five, six more positions, but those weren't existing positions. So managing existing positions out of 30 that I had, um, I sold one contract on two of them. So like I closed out one contract on two of them out of 30 in one day. That's all that needed to be done. Some days you won't even have to do anything, but it could be between with 50 positions, like between one and five positions. It's not too bad. I love following his progress. It's helping me to get to that point. Yeah, it's he took a very nice, brave first step, but he's still paper trading it. Uh he's making all the right decisions. It's like um I just know so many people that I've taught in here who just don't fucking listen to me, and they go and they do it. Not just this system, but other things that I teach, certain day trading, certain swing trading, certain this, that, dividend, whatever it is, people have something they're learning from me. And then, I will recommend most of the time that they practice for a little while and then they don't. And then, you know, they tell me they lost a significant chunk and then I don't see them again and then they disappear. It's the same old fucking story. But the ones like Randy and yes, RJ, I think was another one. All the ones named Randy, they did really well because they did a lot of paper trading practice. I think RJ paper trade practice, day trading practice for like 6 months, and I think he still does in part. That's pretty great to do. Um, but I would also say that if you do try to do this with real money, this system, and you've copy pasted that and you printed it out or whatever, and so you know the rules, and you think you have it kind of like semi down, and you want to just give it a try, I am here. Okay, so like Randy Winkler, he private messaged me a lot. All right, Ben. Randy Weekly, he messaged me a lot in the beginning when he's like, okay, I'm going to give this a shot, and we had private lessons also. And, he really wanted to make sure, uh, of it. And then once he had positions on, I'm there helping him. He had things upside down. He had them backwards, inside out. Like he, sold the wrong strike and bought the other one. And instead of making money, he lost money. And that's very common in the beginning. And because, you just don't fully understand it, that's what happens. And it's another reason why if the position's smaller, 1/50th of your account, that if you do make a mistake, it's a much smaller mistake. So that's why, in a strange way, I would recommend for beginners to go for the full bore 50 position slots. It's just going to accelerate your learning. It's like sink or swim. I think this application is sink or swim, but it is like sink or swim. It's like you push somebody out there and they have to manage 50 positions. Like you'd be surprised at how much mental capacity you have. It's not hard to manage these positions. You can like manage one while maybe five others need management for a few minutes, and then you move on to the next one. You're welcome. Ben, you're gonna pay for trade 50. I need a goal. Thank you. There you go. I mean, you're gonna accelerate your learning if you do that, you know? Yeah, what was that? I think there might have been one other aspect of your question that I didn't get. What was that again? And do you ever have a hard time getting a full 50? That's such a great question. Do I ever have a hard time getting a full 50 positions up and running? Yeah, man. But like once you're off paper trading and you're actually using your real money and you're getting results, it's one of the most exciting, thrilling, and really the best word is rewarding things that you can spend your time on all of a sudden because it's actually rewarding. And what happens is all of a sudden, like let's say you have, to make the numbers easy, $50,000 in an account, and you've got 50 positions up. Each of them are around 1,000 in size, and every day between 1 and 5. So let's say 3 or 2 got snipped off. Their targets got hit, whatever. And maybe you weren't there during that time, and you came and you checked on it like an hour before the close. You checked on your account, and you're like, oh shit, it looks like this sold and that sold. Great, awesome, love it. But now what do I do with the capital? Because it becomes so rewarding and wonderful that it worked and you made money, that now you want to keep it going, because in order to achieve the maximum return that you can achieve in 1 year's time, you have only 251 days to do so. 251 trading days. And every day that you miss where you're not fully allocated to the 50, you just absolutely know you're not maximizing your capital. It's sort of like in real estate, if you own an apartment complex and you know that it takes 1, 2, or 3 months to get a renter in a unit. So when somebody vacates, it's like there's this anxiety about actually getting that apartment filled so you could be making more money again. And it becomes all about maximizing occupancy. And it's like that. So Colby says, so realistically, you're only needing to put on a few positions each week to maintain your spread, maintain your portfolio, once you are up and running. Once you're up and running, um, yes, but I would say it can be. Interestingly enough, because of the way earning season is and the certain runway of time, 2 or 3 months until the next earnings, there's this window that starts opening where it becomes easy. Everything starts qualifying, because there's tons of charts that I wanted to get into over the last few weeks, but I couldn't because earnings were coming up. So I couldn't quite allocate. Now, as they're becoming released, I'm able to allocate. Like today, I got into Microsoft. Like now, I have Dell, I have Microsoft, Moderna, Spotify, Nvidia, amongst others. But those were so big, and those were ones that I really wanted to be in, but couldn't get in because the ER was coming up, a catalyst was coming up, so it would get in the way of the trade. Now this window opened up, and so what happens is all of a sudden, in a week and a half, or maybe less, it depends, but in about a week and a half, maximum 2 weeks time, you get that 50, you fill up to about 50. And then here's the thing, those are supposed to gestate for about 24 days, because if it's ideal, like if you got 45 days to expiration, and then you're supposed to sell at 21 days to expiration, that means 45 to minus 21 is 24 days. So it means from your entry, you've got 24 days until, if nothing else happens, 21 days until expiration trigger occurs. So 24 days will go by, and 21 days to expiration trigger would occur, and then you clean it out. Well, that period, those 24 days, that particular period becomes this large waiting game, and there could be days in there, yeah, where you do nothing and you've got 50 positions, and that mostly has to do with the fact that there's nothing to do. However, I will say this, that probably you could check on them every day, maybe even multiple times a day, potentially. It's just that you'll notice, you're like, well, I mean, that doesn't there's nothing lining up with any of my rules here. So that's good. You check in the morning because that's when the things could snap to where they're at, right? And then maybe some rules start triggering. And then if that happens for me, if 1, 2, or 3 stocks are got into the zone for an exit, whether it's a bad or a good zone, uh, then you're faced with the decision of, do I just close it out right now and do it? Or do I let it go for till midday or another hour or half an hour? Should I have some breakfast? It's very interesting because this system teaches you to be a very patient trader, which is a lot very difficult. Especially coming from day trading, or even swing scalping, and being in things, share scalping, swing trades. It's really strange, but it teaches you to be down for 2 weeks and be completely okay with it because it's following the rules. Where if you're not down 100% max profit, maybe you're down. I've had things go down minus 127% max profit at the beginning of the day. And I'm like, well, shit, but by the end of the day, it's frequently by the end of the day, they're at like negative 98% or negative 82% or whatever. And now I'm within my rules. And the thing is, when you look at a daily chart, and if you back test a system that's using a daily chart's data, then it's always the end of the day, the close of the day, and everything that transpired within that day that uh, triggers any of the rules. And so waiting to the end of the day to see if it still matches the rules uh, is one of the most diligent things you can do. And it just teaches you, again, it teaches you to be patient. It's fantastic in that way. Each week to maintain your spread. So there'll be periods where not much is going on and you've got 50 positions going. And then there'll be other periods where it's now time to close all those positions out. And in a frenzy, you're like, well, shit, what do I fill them back up with? But believe it or not, maybe a quarter of them to even half of them, depending on how the market is going, um, will be such that when you close them out, you can open a new one up on the same exact one. It's like you had Meta for 24 days. Yeah, and then now it's hit all the profiting and stuff, and so that for that expiration option, it's time to close it out. And there's still 21 days till the expiration, but you're done with it. You throw it away. You give it back to other traders who start trading the riskier dates to expiration, which are the last 21 days, and you open up a next option chain one that's 45-ish days to expiration. It's between 30 and 60. 45 would be perfect. On the same stock on Meta. You're like, I mean, this formation looks good. I mean, where's it going? I mean, if this thing, there are some charts, even today I've been looking at many of them where every time it does a pullback, it's well within the break-even line's rate of descent, if you will. I was kind of showing that this morning. I don't know if you were there. And um, so therefore, theoretically, logically, it means that if you were to open a put credit spread at any time on that particular stock, if the history of it shows that all pullbacks are never more extreme than the rate of decline of the break even line, then at any time you could really open up a put credit spread on that stock. And you've already got the sort of safety in mind of knowing, well, I'm going to break even if this thing just pulls back for the next 3 weeks. And then at some point it lifts off and it's outstanding. Kava is a great example. Like, well, not really. I did super great on that. I was going to show how, I was in it for a long time and then phew, it took off. You could almost say that that's the case. So I'm going to clear that off because look, um, from here, so it's off. If I had taken the put credit spread at any time, let's say uh, here, and it was, roughly this length, it probably would have looked something like this. It would have been at that angle and I would have been underwater. That's true. Minus 30% there, perhaps. Back to minus 5%, maybe. Ooh, back to, minus 85%, 95%. Next day, whoa, back to minus 20%. And now I'm in the profit for a couple days there. And then now I'm underwater again, underwater. And now it's like 20 days in, right? Uh, and I've got like 3 days before expiration, and then boom, 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 and then here's 21 days to expiration, and it's at 89% max profit. Like I did super well, And I can have the what's rest easy. I can rest easy knowing that my break-even line, descending break-even line of the PCS sort of matches the rate of decline of natural pullbacks in the bullish trend of whatever stock that is that I'm, you know, considering that on, and that I really don't have to worry too much. Now, if that was another stock, that might not be the case. Some stocks, could be more not match that break even line. And so you would have that difficulty of having your decision would be that much more difficult, or you would not be able to rest so easy getting in at whatever spot. But most of them do have a natural pullback rate that's what's the word? It's not a conspiracy theory, but it's suspiciously matches the break-even line's descent angle. It almost makes you think that the options are priced manipulatively to take advantage somehow of the pullback, and that the whole pullback is sort of a recycling of money, people getting in, people getting out, people getting in, that kind of a thing, that ebb and flow. And those rates of descents in a sense tend, although you should double check, but tend to match the options uh pricings, their premiums create that same anglage. It's amazing, really. It's kind of interesting. I can show you stocks today. I got in some stocks today that had that aspect. Let me see here. There was an iron condor on Root, was it? I think it might have been Root, but there might have been another good example. We're gonna Google, perhaps. Let's see. Yeah, so I got an iron condor on Google, which is again iron condor. Don't let it trip you up. It's just a call credit spread and a put credit spread. It's just both. It just happens to be that both theses were good. So, you can probably see by the naked eye that the kind of rate of incline here on Google is something like this. So this is not matching it, perfectly, but it's also not an angle. It's not way off. It's pretty close. And then look at the pullback angles. It's kind of a more steeper one. And I've got this. It's both the up move angle and the down move angle is well within the realm of reason. Aside from that, the thesis on this trade is that we have this never look back resistance day that turned negative. So this is going to be a point that's going to be difficult to go through. It's probably going to bounce off one time, so it's going to give me time. It's going to work in my favor when that comes up. And then it came down, didn't fill the gap all the way, came back up halfway, and I'm sort of testing a theory. I'm calling this the gap and sag. So it's when you have this large gap up on something and then it sags. And then when it gets back up to about halfway through that move, so this looks like it took 2 weeks to create that could potentially be a good spot to grab an iron condor. I have a theory about that, so I'm testing it and on a couple things. But so the thesis here on this one is, so we have some top line resistance here. So let's say we make some progress on the stock. Well, maybe it does break through a little bit, and look how it's following my call credit spread, right? Not good, but then it fakes out and it pulls back. All of a sudden, I get like a parabolic geometric increase in profit when it does that, because it's like a rubber band being pulled to its further tension, and then phew, much more so than if price did something like this and came into the middle of my profit area right there. Much more so if it goes up like this and then comes up and then comes down a little bit, just that little bit, just this one move here is like a huge swing in the wrong direction for the people who are hoping that option was going to work out for them. And then for me, I'm making the money on it not working out for them. It's going in my direction and it's going into my profit zone. And then from there, whenever it makes a move like that, it makes it more difficult for it to get up and continue and do this again, right? What it's most likely and natural to do at that point is now do a similar rate of this of ascent at best from the new location that it's at. So something like this. But what's interesting is as time progresses, these levels, even though they look parallelly the same distance, uh, actually contain more profit. It's almost like a triangle wedge like this, and it's getting filled up more and more and more and more towards, completely full as time progresses. That's sort of what's happening underneath it all. And I'm just talking about the call side right now. On the iron condor, together, that's just the dynamic is happening in both directions. Obviously, if price, not obviously, but I'll explain it. But obviously, if price is going up, then the put credit spread is probably at nearly 100% max profit. You understand? If price is going up, the put credit spread's like fucking, rocking solid. But now let's say price did this. So I get in today, like I did, and price goes down here and does something like this. Well, that's the amazing thing of how I constructed this iron condor, got this put credit spread. They're both 20 deltas. I mean, this is perfectly in alignment with our system. Just happens to be iron condor version. It gets down there, and guess what? It runs right into all this congestion area from prior pricing and probably bounces off and does something like this. And towards the end there, if it gets anywhere inside that mouth of that triangle, the profit, accelerates handsomely. I'm probably about 80 or 90% profit by that point right there. So up or down, I'm in a pretty good spot because the break evens using the strikes that I chose on the iron condor here are way up here. This is the top side that I'd have to worry about. And then the bottom side is down there. I wish it was lower, but the way the option's priced, it's right there. It'd be nice if it was like a little bit underneath that first pivot, maybe right there, but it's damn close. If we start testing down there, I have a feeling, it would move back up right inside of there. And if on the very last day, if I had to hold it, because the 21 day to exit rule definitely would be overridden at that point if I was still holding it. If on the very last day it goes right into that triangle, and let's say it's the last day and it closes inside of the triangle, that's 100% max profit instantly uh, in that one day versus all the days I was holding where it was near break even at at a slight loss, 20% or something, following and descending that line. Thing is, within 24 days, almost any stock zags. So if any stock is zigging, I like calling it that because kind of changes this to like the kindergarten of understanding level. Um, stocks zig and zag. They go up and down. A trend is higher highs and higher lows, and then that just takes too long to say. So I just like to say the thing zigs and zags and it makes its way up and it's higher highs and higher lows. And we understand that. And it's an uptrend, whatever it is. Well, the cycle of zigs and zags tends to always be within 20 days or less. 20 days is a very interesting cycle because it's 1 month, 20 trading days. That's 1 month, 20. So zigzag wise, it's kind of rare for something to just be descending for longer than 20 days without having some, maybe 5 or 10 day zag, move up, even if it's going to pull back more. Like, so what I'm saying is on the way down here on Google, let's say, it's doing this and it's let's call this the zigging, okay? And we're just waiting for some zag and it's just not happening, the zigging. Well, it's most definitely going to do something like this at some point and put in some zag for a week. And look where that is right now. It's right dead center of my iron condor. And all I needed was to wait for that moment. And this system opens up the windows and permits you to be able to wait for a moment like that. It's crazy that you could never do that with shares, because if your entry was truly right here, you'd be far underwater down here. But by the time it got here, you'd be at only break even. And yet with this system, by the time you got there, you're probably at 83% max profit, which is, you know, fantastic, astounding return on your capital. All right, clear that out. Another iron condor that I'm in, Tesla. This one's great. I had a put credit spread on Tesla here. I can expand this just a little bit more. Okay, here. And it had a very good day. It was up like maybe 25% to max profit. And then boom, we had that recent news. I forget what it was even. Something good happened. Full self-drive. I forget what it was. China or something, anything. It was just, it popped up, right? It popped up and it seemed to struggle. So the first thing though is that the put credit spread was now at like 95% max profit. It was excellent. What I simply did is I said, instead of selling my put credit spread, what if I converted to an iron condor? And essentially what that means is I end up hedging the put credit spread against itself by opening up a mirrored call credit spread, up at the top here, and trapping its gains and keeping them there. And then what happens is they work in accordance with each other in order to shake out the remaining theta over the course of time. Because I figured this extreme move would probably be met by some pullback, and that would move right into the center of the iron condor. And how could that change sentiment? The thesis, I just have a lot of experience, but the thesis is, how would that change sentiment? It would just be a zag, and then it's going to end up zigging again, but it's going to fall right into my hands because it's going to move right into the center of my iron condor. And this is exactly what it did. I was correct. It moved right into the center of my iron condor, which is right in the middle here. Well, it's kind of like at an angle when I opened it up between all those points. And I'm waiting for, even if it goes down, kind of like, I'm like, damn, man, it's really not giving me any zag. All it's going to take is like one good day, and then sentiment to bring it back up here. It's moving up, and now it's not around my center again. But guess what's going to happen? It's going to be, maybe it's a double top here or whatever, and it's going to move right back down to the center of my iron condor again. So I mean, you can get really good at this shit and putting these things on. And what that does, by the way, when you open up a call credit spread on top of your put credit spread, it gives you margin on top of margin. Because check this out, whenever you open a call credit spread on top of a put credit spread, so long as it's the same expiration and the same wing size, although, in more advanced classes, I'll show you how you don't have to actually do that. But so long as it's the same size spread on both sides, same expiration, it doesn't require any more capital. It's the most amazing hack ever. So, for example, all my money in this account that I use in my portfolio here is in bonds. So you would think, oh, I can't even trade. But on top of the bonds are really cool, different in that you can margin up to 80% against bonds. Whereas if you had a portfolio of stocks, you could only add 50% more on margin, because stocks are only 50% marginable. So I get 80% leverage. I get 80% more money on my bonds. So you put your money in the account, you buy bonds. Those are making 4.5% per year, and they will change in value when the Fed lowers rates. So their value is going to go up. Your account could double if we start lowering rates. And then with the 80% margin, I'm running the max profit system. And from there, imagine you can only get 80% of your capital to work. Well, if you go iron condor on any of those, you get a free extra trade. You get free extra return. You get to put another credit spread on for free. And the reason is this, in case you're confused as to why. It makes total sense, and it's just kind of an amazing hack in the system, is that if you put a put credit spread on, it requires the amount of capital required is the distance between the spreads. That's just the way it always is with the amount that they require. Okay. So if it's a $5 spread, like a 151.45 put credit spread, that's a $5 spread. It requires, in theory, $500 for you to put up, minus the credit. But it's okay. Just call it $500. Now, if you do the same thing on the other side for a call credit spread, not at the same time, but let's say you just did one of those on something, it would require $500, right? But here's the thing. If you already put $500 collateral down on the put credit spread, they don't require you to put the other $500 for the call credit spread if it's at the same time, because think about it. There's no way, it's physically impossible for the price by expiration to expire down and up at the same time. You don't need to give them another 500 because one or the other, if one doesn't work out, the other one did work out. If this one doesn't work out, the other one did work out. So they don't need 1,000. It doesn't require an extra 500. So it's amazing, but you get to put on a second trade for free and theoretically double your rate return on capital, your rate of return on capital. So instead of getting 25% or 20% ROC, you can get 40 to 50% ROC. Now, I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 positions like that. I have 10 iron condors. I have 10 positions that seem to be good setups for iron condors. And some of them are working out, some of them aren't. We'll see where they go. They're all just gestating. They might all work out. These things take time. Patience is part of the system. But I have about 20 uh, longs. So I have 10 iron condors and I have 20 put credit spreads. Put credit spreads are, bullish. They're long. So that's amazing. That's one of the amazing parts about the iron condor thing is that I've got 80% that I can margin off of my bonds. So, and I'm using that 80% money to run a max profit system. And then in there right now, 10 out of 30 positions, so a third of those positions, I'm actually getting a free extra amount of return on fake capital. No capital. It's like phantom capital. It's phenomenal when you think about it like that. That actually can happen. Um, so it's almost like I have another free 10 positions because I have 10 positions that are put credit spreads and the same 10 positions have call credit spreads. Well, in some sense, that's an extra 10 positions I got to put in my portfolio for free. Now, should the situation be more perfect across more of my put credit spreads, I would convert those and do the same. But I'm having a hard enough time, like you just mentioned, just filling up to 50 positions long, which is what I ideally want to do. So, but you have to count the iron condors with my bullish positions as long. So I have 30. And then I have 3 shorts. So I have 33 total positions. And then on top of that, I have 10 more on top of 10 of those to create the iron condor. It's kind of hard to think about, but yeah. The situation has to be right. Like this one on Tesla was, this made sense. And also, by the way, that is kind of a gap in sag, but it gapped and gapped way up. A little bit different. Robinhood, crowd is something. Let's see. 25%, 25, 23% on DraftKings. Let's see. So somehow on DraftKings, only a couple days ago, I opened an iron condor on it right here Oh, this is so perfect. Let's just take a look at this and analyze that for a second. Because look at this. This was an earnings release right here. So, it's making progress. It kind of goes sideways. Let me double check. That might be an earnings release back there. No, it's not. Okay. It's moving sideways. It goes on this phenomenal run and it just can't sustain it. Falls back pretty hard. Comes back down to that whole area that it was in. It really tried. And then on earnings release, it's opening way up high. But what does it do? Goes the other way. So it could have been a break and run, a breakout and run trade like this, for the next few months. But it wasn't. It faded that day all the way back down to here. And then I think it was this next day when it came back up that I said, so what? It's quick because we know that on catalyst days, one side or the other side, depending if it's red or a green day, is likely to be a side that's not breached for a long time. It creates a heavy resistance or a heavy support. So it moves up that next day, and I'm thinking, okay, this level is not going to easily be broken, and even if it is punctured, it's gonna, it's probably going to be tested and maybe come back through and back reject and all. It's going to take some time. It's going to have a sideways pressure on the stock. To say nothing, right, about the fact that you have this overhead head and shoulders resistance, all these pivot points that it's going to have to break through, which, so that creates a lot of pressure overhead. And then I'm thinking, okay, so I'm could open up an iron condor right here. And if so, then do I have support on the low side is the next question. So I could get a call credit spread, but it looks like I could probably also get a put credit spread because I've got this 3 times supported level here, which appears to be about 40 dollars is a certain line in the sand. And so, it kind of lend itself to a construction. The other thing is it appears to be wanting to try to be bullish, you know? So, and opening up high that one day is sort of like a check in the bullish direction, but it's just having a hard time, right? Well, while it's struggling, why not open up a sideways trade at double the return on capital, the iron condor, and put the strikes well outside the bounds wherever they are. I'll look it up right now to tell you what I did get. And let it play out and let's see. It just seems like a good thesis for where things are going. Yeah, look at this. I got something like the 39 probably, and the break even is 38.28. It's like well underneath that $40 level, 38.28. And then on the top side, 50.45 is my break even. It's like well above. It's going to take a road, what is it, a pit stop. It's going to take a pit stop here when it gets there. It's going to reject around and struggle. And then what about when it gets here? Yeah, it's going to probably struggle around. And when it gets here, yeah, it's probably going to struggle around. The chances that it's going to ever get up to 50-50, 21 days before expiration. So like we're talking back here to ruin my trade, very low. Not going to happen. It's likely to be bouncing around in this triangle at that time. And in fact, 3 days later, just it moving across the triangle, like just just kind of whiplashing, has caused it to be up 23% already since entry on Iron Condor on that. And also, if you take a look, notice that the angles of those break evens tend to match the rate of incline on the stock. And also, I should show you something a little bit advanced, intermediate, is that you don't necessarily want to measure the angle of incline of appreciation, the appreciation angle of the stock off just the zig. you kind of want to go off the zig and the zag because you're in it for that long. If you're in it for 24 days to the 21 day to expiration line, and as much as 45 days if you do any overriding, discretionary overriding. And so, really, when you account for the zags and the zigs, the rate of incline on this stock is like this, because I'm touching the tops of the pivot points now. And so that's really the rate of incline. And then the rate of decline, when you do that, are like, very tender, something like this, about like that. Look at that, matches up pretty close to mine. And we have back here something that's probably closer to something like this. So, this is a pretty good setup for that for an iron condor. I don't know if that matches any points. Wow, I'll be printing out this screenshot. Oh, there you are. Yeah. Yeah, yeah, yeah. That was really cool, right, Randy? Uh, and then I wanted to wait for you to come back to talk about your subject, which was the return on capital thing and stuff. So we'll do that in just a second here. But are there any questions about that so far? It's a lot of fun when you guys start to get used to this. Um, we're gonna have like even more to talk about. You guys are gonna start to ask questions. Even Colby's already asking kind of very interestingly, high level questions about this stuff, and those are the best. But I also don't mind talking about the basics as well because that blows my mind too. That the basic system and the basic rules and the basics of the system um, are very interesting to me as well. So don't think at all that like I bored with either or need high level conversations. No, just that it could be quite interesting when you guys start getting well versed with this. You'll start to bring questions and perceptions and um, that are very interesting and high level aspects of this stuff, and we can talk about them and we can have answers and we can resolve through those interesting dilemmas or whatever they might be. Colby says, I've been running a paper account with a spread, but I've been neglecting it. But I am paying attention. Yeah, yeah. So if it doesn't have a bunch of positions and they're not well chosen, you know, uh, it runs the risk of being under a lot of pressure. You're going to get out of this how well you feed, the dragon. So, the food that you feed the dragon, so if, like, for example, if we put Rivian in there, like, that's no good. Looks like, okay, I had some calls on Rivian and that worked out really well. Looks like there was also a PCS in there, but yeah, I'm sure I closed that pretty quickly. But Rivian's no good. I mean, number one, it's bearish, number one. But I'm trying to think of ones that are like a little bit more subjective. Let's see. Like, here we go. Palantir. No, I don't love rashing Rivian necessarily. In fact, there's a couple, maybe two or three Rivians here on the island, and they're really cool looking. They're pretty damn cool. But unfortunately, yeah, I think it's gonna be dead soon. And that other one, Lucid and Neo, they're all dying. They just, it's tough business, man. So anyway, but look at Palantir. Uh, you know, yes, it's going up, and I mean maybe a put credit spread would be fine. But it's kind of still a crappy stock. It's $21. Probably you'd find the options are. We can check it out here. Let's see. 372,000. Well, the options are very liquid. Okay. The 21st of June is 43 days to expiration. If you wanted to get the 20 delta, it looks like the 19 strike you would sell, and then the 18 you would buy. That gives you $16, which is not too good. Out of 84, 16 divided by 84 is 19% return. That was for 19 delta. Okay, so it's giving you the return that matches the delta. So that's it's kind of okay. The spreads are a penny each, so it's pretty tight. That's good. The open interest is 11,000. That's outstanding, and it traded 1,000 shares on each of those. Actually, everything kind of lining up good for Palantir, but this is probably bottom of the barrel. Some of the stocks that I'm in that I would say are better quality, Wingstop, uh, not just because of the chart, okay, not just because of the chart, but because it's Wingstop. It's to like y- give a little bit more weight to that something's a name. Palantir is how okay. I'm less familiar with it, but for example, how really much of a leader in cutting edge and does it come to the forefront that when you think of whatever service it's providing, is it in that industry, in that domain? I'm going to guess, it's not, it's one of many, many, many. Well, Wingstop is too, but Wingstop's quite the name, right? Wingstop's well established. DraftKings, everybody knows it, So DJT is a good example of um, exception to the rule because DJT is kind of all over the map. But at the time that I was getting into it, I didn't know it was going to be so crazy like that. So I saw, DJT, this is, up and holding. And I thought to myself, well, shit, next time it makes a good move, I'll get to put credit spread because a good move usually, instigates more move. And that's a good time to get in because then, you'll already be up. That's why we always get in on a green over red type entry signal, right? So anyway, it's just like a cheap entry in a consolidation on a stock that kind of holy grail. So it went up, but then it came back down, and then it went underneath. So there's my put credit spread. Then it went underneath my put credit spread and stayed down there, close to minus 100% this whole time. Amazingly, didn't trigger any of my rules. Every day I was ready to cut the damn thing, and then now I'm at 100% max profit. So it took time later, but this is an example of a not very good quality stock to, you know, do this stuff on. This is a very expert override here because that particular stock is hype. It's got lots of option liquidity that's probably not going anywhere. It's not going to become unhype. In fact, it's probably going to get more hype as we get closer to the election, right? So, there was a lot of expert override factors that went into getting DJT. But for example, uh, you can make exceptions, okay? But you're looking for things like here's Kava. You're looking for things that are just smoother, a bit more reliable. So, Colby, be careful the picks that you do. Don't let them be. I don't know. There's probably other stocks out there that are good examples, but don't let them be those one. Don't let them be the Neo is a great example, but I think that's just because it's bearish. Like, don't suddenly like something's Neo has been hot the last 2 weeks, right? Because it moved up, right? But it's done that before. Look, we could have said that this right now, Neo's right here. I could have told you that, and without looking at the dates, you'd have been like, okay, I believe you, so it's moving up off the bottom. And then what did it do? Went way down. And it's doing it again. So who gives a fuck? Because it did before. It's done it many times. It's under the 200. The fundamentals are not looking good. It's in bad shape and it keeps getting worse. And it's been getting worse. And it's just down and down and down and down and down. So like this is a situation where you hear something wherever it is, the chatter, and you get excited about it, and it's making a move, and you go look at the options, and they're liquid because it's kind of a hot stock and it's kind of hype lately, and it's all liquid, and then you get in. You do not want to be getting into a stock like this. You want to be getting into something solid. There's so many. name, not, not a ton, but there's a few hundred. I mean, like, and if you run out, go to fucking industrials like Caterpillar or Deere or um uh Boeing or things like that. The ADRs are going to be lower, but once you look under the hood over at the options, if they're paying 25% ROC for a 20 delta, end of story. That's perfectly fine. And look, by the way, look on Caterpillar here. It has such obvious angles of ascent and angles of descent that when you go into the options, let's just do it now to take a look at it. Um, you can check to see if those options, if those angles for the break even line on the options match up. So we go over to the 20 delta. By the way, this is my delta column. I know I'm moving kind of fast when I go through there, but this is the delta column that I'm looking through really quickly when I go to the 21st of June expiration, which has 43 days. 21st of June, which has 43 days until expiration. That's the delta column there, and I'm looking on the put side, and I'm looking for around 20 delta. Here's an 18. The jump from there is to 29. I would never get a 29, never ever get anything beyond a 27. 18. So I would go with that one. Look at this. Already the spread's a little bad because it's like 40 cents out of $3, which is close to like 12%, which is okay. Okay. 15% is where you should, your cutoff could be. But tighter and tighter, like 5% spreads even better. So it's not great. And then similar spread problem on the 320 that you have to get on the other side. You're getting $138 credit for an 18 delta spread that's $10 wide. And so the math on that is $138 for $862 of collateral. 138 divided by 862 collateral is, I'm doing the calculator now. Sometimes my computer's kind of being a bitch about calculator stuff. Oh, there we go. 16% return on investment. So already the ROC on those rules that I had up earlier, the ROC is not greater than or equal to the delta. The delta was 18 and we're getting 16. So this is already a no-go, but I just wanted to check the lines, remember? So the 18 delta descent line from today's price is to, well, let's do it with trading view, is at this angle. Let's find it, June 21. Let's go over to June 21, and we were talking about the 330, 320 for $1.38. The 330 for $1.38 would be right about here at 328.68. That's close enough. Look, credit spread, and you can see that this stock can decline faster than your break-even line. Look at that. And the ROC is not giving you the return on capital is not giving you the return that's greater than the delta. So it's automatically part of the system. It says, don't get in that. If you were getting a 25 or a 30% return on a 20 delta, most likely it would match the descent line. It would match the natural rate of decline of the stock. This one does not. So it's not good. It's not good to get into. So isn't that cool? Yeah, and so there's just lots of stocks you can pick from. Microsoft I got into today. That was an iron condor. Another one of those iron condor situations. But and this one's a little bit riskier. It's Microsoft. It's not risky, but it's a little bit riskier to working out. But we'll see what happens. I think I've got my thesis lined up pretty well on it. Had a very similar situation where on earnings day it came under pressure and created this never look back, which has now double topped right here. Never look back high, which dumped and then came back and is now sort of bounced around. And that created this sort of point that we're at, and this point that it was at, and this point that it was at. You see, and it's like there's 3 points. It's like where we're at, it's under pressure. We're going up because of all this congestion and this never look back. And you know, this downside uh gets bought up many, many times. It's had many bounces off of these lower prices. And so it just seemed like, a good iron condor setup. So we'll see how that plays out. Hopefully it, ends up staying inside my iron condor zone there. Been a lot of talk about iron condor, but the amazing thing again about the iron condor is that you can get double the return on capital by putting it on. All right, well, cool. So we're going to talk about. Is there any other questions? Let's just quickly ask that. But I was just addressing Colby's statement of that he'd been neglecting and running a paper account, and he was neglecting, and but he is paying attention to it. But I sense that by saying I've been neglecting it means it's down. So that means maybe also automatically you didn't pick the best, you know, magic beans. The sorcerer, you know, you're trying to run the magic system, but you put in there like some rocks instead of magic beans. I'm saying they're out there. Try to find them. Focus on higher quality. Uh, don't just jump on things because obviously if it doesn't qualify, then don't get it. It's much better to not have things that don't qualify than it is to have things that don't qualify. Whatever. It's much better to not have anything than to have things that don't qualify. All right. Okay, it seems there's no other questions. Let's move on to these other two topics now. That's cool. We were talking about the system and how we can do PCS and the whole system, and a lot of iron condor talk was in there as well, and some of the beauty of all that. How you can make more money than you're even allowed. Coolest hack ever. So max profit versus return on capital. Um, Randy had a question about that. Randy, do you recall that question? Do you think you can reformulate that question right now in the chat? What is it you're confused about the two? But I'll go into them. But do you think you can take a second to sort of ask that again? Let me sort of get into the swing of things by your question. So we're going to talk about return on capital of spread and versus max profit. What's the difference essentially? So return on capital is for how much you invested, how much uh, gains you achieved in comparison to how much you invested. So it'd be your P&L essentially of that trade divided by the capital required, right? So that, and I can show you like where that is and how that comes up in the options in just 1 second. And then but the max profit, no, definitely not. Well, no, definitely not. Okay, that's right, Randy. Okay, that's your question. Okay, no, definitely not. And then the max profit in dollars amount is the, I guess you could say, expected uh maximum that you could make, which would be that P&L amount, the profit, I guess you could say. It's a max profit in dollars, but in percent, it's 100%. So the max profit is 100%. And And that's not on your capital. At most places, like I think Robinhood, Webull, Thinkorswim, a lot of these places, when it comes to spreads, you have what's called defined risk. And defined risk is a maximum profit you could make and no more, and a maximum loss you could take and no more. And those are usually, uh, but don't quote me on this, those are usually something like plus 100% and minus 400%. That's a good rule of thumb. So you just think about it as you're getting $100 credit on a $500 width spread. So a $5 width spread times 100 shares, $500 collateral minus the $100 credit you're getting is $400. So the most you could lose is $400, and the most you could gain is $100. And then, when you tell people that, uh, immediately they get turned off of spreads because they think that's ridiculous. And I used to think this way, so that's why I know that people think like this. They think that's ridiculous. Why on earth would I take a bet where I could make $100 or lose 400? Why on earth would I do that? And Randy, just from doing this now, that you never let it get to the negative 400 point. You never. I mean, we try to cut it at negative 100. Truth be told, sometimes it hits negative 150%, and then even I've had it hit negative 180%, and I've had to cut something. So sometimes the losses can spiral out of control really quickly on rarer, but as they are, but it can happen. Okay. And then maybe, once a year you can hit that max loss. That can happen a couple times a year, maybe, out of, thousands of positions. But so spreads are, yeah, but no, but the rule is to sell at negative 100% or more. So even though there's more time, you really should snip it in the bud if it's at negative 100% or more that day. By the end of the day, at most, you probably should just get rid of that position. Except for if you can make some kind of a professional override on that, which can very well happen. Okay, but the difference between returning capital and versus max profit. So max profit might say that it's a particular dollar amount, which let's just call it $100 on a $500 spread. So the max profit could be $100, and that's also going to be expressed during the trade as getting to 100%. 100% max profit is going to equal 100% of the value you expected to make in dollar amount as a profit, which in this case was $100 also. Okay. So when you get to 100% max profit, it represents the maximum amount of money you expected to make when you originally opened up this trade and it calculated. The cool thing, one of the really cool things about the whole spread trading thing is that at the beginning of the trade, you already know what you're going to make or what you're going to lose in some sense. That's pretty cool because with shares, you never quite know. One day you're going to make 1%, another day you'll make 7%, another day you lose 8%. It's a little bit, and it's called defined risk. These are defined risk trades. They're very special and unique, and to spread trading, defined risk. So, anyway, continuing on. So, max profit is how much you could make. Now, return on capital is a percent return on capital. I mean, the return on capital, ROC, is almost always a percent figure. Now, you could say it in a dollar amount, but that's not usually what is meant by a return on capital. Return on capital is a return. A return is usually expressed in terms of performance and expressed in percent. So, yes, it could be The dollar amount, $100 could be your return on capital. But as I've put it here, return on capital usually is more expressed as the P&L of the trade divided by the capital required. So if you made $100, it'd be $100 divided by the capital. So $100 divided by $400 capital required is 25%. That's a 25% return on capital. So you can see already the difference where we're using the same figure, $100 divided by 400 is equaling a 25% ROC. Whereas over here on max profit, 100% equals $100. It's kind of different stuff we're talking about. You see, 100% max profit equals $100, whereas a hundred, whereas a full expected return on capital on $400 is 25%. So one's expressed more in percent and the other one's expressed more in dollars. And then at that, you're going to see like, okay, I'm at 50% max profit. I should exit now. And you don't even know what that is in terms of return on capital yet. Okay, until you've figured it out. But 50% return in the case of this one where it's $100, you would know is $50, right? So 50% return, $50 on the capital required of $400 turns out to be probably 12.5%. I don't think I need to do the calculation, but it should be half of this 25% return on capital. And so the return on capital of a max profit of 50% is 12.5%. 12.5% becomes the number you can tell all your friends, I made 12.5% return on capital on that trade. And one of the things I mentioned in a previous class, so just to take it further for a second, one of the things I may mentioned in the previous class is you expected to make 25% return on capital, and this goes towards performance, but you expected to earn a percent return on capital in X number of days, which we try to make 45 days to expiration. Right? But what happened was you got accelerated gains, you got out, earlier, maybe 7 days into 45 days to expiration. How many days is 45 divided by 5 is 9, right? Um, well, I'm just trying to think of like a quarter. What's a quarter of 45? 22, 11. So roughly, let's say 11 days into the trade, you hit 50% in 11 days. Then that represents an accelerated gain. And performance wise, this is different now, a little bit different. You were expecting to get 50% in, you would expect in half of the time, 22 days, but you got it in 11 days. And so you can use reverse compounding math in order to find out how much per day is that, and therefore how much different of a return is that in 1 year when that happens versus expected return, which is 25% in 45 days. Okay, we can do that math right now. So 50% in 11 days, hitting 50% max profit, I should say, in 11 days is how much ROC? Well, obviously it's 12.5%, but it's in 11 days. So we'll call it like that, in 11 days. But what does that equal per day versus the 45 day? So we're going to do that right now. And so 12%, 12.5% is 1.125 in a calculator. I'm going to pull up my calculator. Can you guys see this calculator? Does it show that? Okay. So 12.5 percent is 1.125 when you kind of express it. 12.5% gain, like in addition to the original 100% of capital that you had. If you made 12.5%, you're talking about a total of 112% of stuff. You get the original 100% of what you put in and 12.5% more. So it's 112.5%. Okay, so it's 1.125 in decimal or however you want to convert that out. Okay, so that was in 11 days. Now, I don't even know if can this calculator get more advanced? Let's see. Calculator view, programmer, scientific. Oh, yeah, that's better. Okay, I think that'll work. Can't quite remember how to use these calculators. And then there's reverse Polish notation. Don't even get me started. But 1.125. And what we want to know is what does that compound back down to in one day if it took 11 days to get that? And what you do is you do it to the power of, so that would be, yes, to the y of, we do have parentheses. Okay, 1 per 11 days. Right parentheses it? No. Okay, we're gonna have to skip it using that and use this because this is definitely works. Okay, 1.125 to the power of 1 over 11. Good, it showed it. Okay, 1% per day almost compounds in 11 days to 12.5%. So first of all, let's write that down. In one day, it's 1.076%. Percent per day. And then so what does that equal per year on a yearly basis? That's what we want to know. Annual return. APR, you would call that. So we'll just call this APR when we get this figure. So back to that calculator. And what we do now is you put that in parentheses. 0.125 or 1 over 11. To reverse compound something, you just put it to the power of 1 over the number of periods you're trying to reverse compound down to 1 period. Okay, and then now we're going to take that, surround it by parentheses, so that we can take that 1 day figure, and we're going to compound it 365 days. So that give you the annual rate. And it's 4,881%. Is that what I said? Yeah, I think so. 4,881%. Now, how does that compare to if we got 25% in 45 days and we had no accelerated profits? Let's do that right now. So that would be 1.25, 25% in 45 days. What is that per day? We do to the power of 1 over 45 days. And we get 0.497, 0.497% per day. So we were going to write that in 0.497. And so what is that in terms of APR for a whole year? Well, we now have to put that to the power of 365. And we get 511%. So you can see that it's very interesting, but by getting double the speed, roughly, in 11 days, by getting to the 50% point in 1/4 of the time, that means you sped up your rate of return by double, essentially. But if you were to keep compounding that kind of stuff over and over, if you kept doing that over and over and over, it doesn't just double the APR from 511% to 1,022%. But because it compounds, because now you have more money to do it with, and you're growing in percentage, in proportion, and you're reproportioning your position sizes, and it's growing in proportion, and your returns are growing in proportion, you actually are getting almost 10 times that in a year's time. 4,881% compared to 511% APR. So when you get accelerated gains, uh, it does remarkable and astounding things to your portfolio. Randy's probably right now freaking out because he typically is getting 50% gains in one day instead of 45. So his returns are going to be, they're going to create a black hole basically. His returns are beyond the event horizon. They don't definitely break the calculator. So Randy's doing a really great job. But the problem is he's not diligently allocating his capital enough, which is, that's what becomes the problem. I mean, amazingly enough, once you have this all down, that's not enough. The real problem becomes making sure you're putting your money to work, making sure you're putting your money to work. If you want to really maximize those gains, you got to always, you got to be there as much as you can to make sure that you keep pushing the edge, with all of your capital. 'Cause, otherwise you're wasting capital. I mean, it sucks right now. I have like $28,000 that isn't invested. Like I need to put like some capital to work, and I really, I'm trying to find positions and stuff to put it into, and it sucks because I want that capital. I want the bigger numbers, and I want the bigger returns, and I can't get them unless I'm allocating. And sure, I could double up all my positions and just be there, but then I'm really not getting the law of large number type of thing going. And now I'd only have 25 positions at any one time instead of 50. What did you got here? These are your positions. So I told Colby that you had 16 positions. I guess I lied. Jeez, wow, look at this. One, two, three, four, five, six, seven, eight, nine. Some of these zeros, maybe you sold them. I'm not sure. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Actually, yeah. And the QQQ 19. The QQQ is a hedge, so it doesn't count. Yeah. So yeah, these look great. SG, this really did not work out, huh? I think that's something we got in today or yesterday, right? Oh, SG is wrong. And what do you mean by that? Oh, it's one of those ones that's the bid ask is flipping around. It's actually doing okay. Yeah, I have one of those too, NTNX. And it's really frustrating as fucking hell. I hate that because throughout the day, I know exactly where I'm at, but then at the close, all of a sudden, just fucks with my um, portfolio balance, frankly. And yeah, I really hate that too. Yep, that happens. I absolutely know what you're talking about. So actually, all your positions are doing, I'd say, quite well. And what you'll notice, everybody, is none of his positions. You guys can see this, I suppose. Yeah, I think so. None of his positions are more than 50%. Why is that? Because when they get to 50%, he sells and reallocates the money. And what I was telling Colby earlier, and you might not have been here, Randy, during when I said this, is that even when you get out of a position on something at 50% gains, it doesn't mean you can't get back in and start the cycle over again. Because I'd say 10 to 25% of the stocks that I get out of in that moment qualify for getting back in. Now, obviously, when you get back in, you're not going to get the same expiration and the same strikes. It's a new trade. So, but that's interesting is that so even though we're looking for to fill up our portfolio with 50 positions and opportunities, and it's hard to find them, don't forget that the ones you're in and just got out of that you need to relocate money into other positions can go right back into the same goddamn position, especially if it's later, like maybe it's 25 days into the trade or whatever, 24 days. It's, you got to the 21-day expiration or whatever it is. The trade has gone on for a while. And then now everything's looking great. It's time to exit. Great. like I showed, and then again, I'm not sure if you were here, Randy, but on any stocks that you might have been in and you got out, or any others that have a rate of decline during their pullbacks that matches the rate of decline then of your break-even line for the put credit spread, it means theoretically, logically, that anytime you get in, you're safe because at worst, it's just going to follow that line down. Like if that was the last good day and you got in, and now it's going to do is be underwater. Well, it's going to follow your line being underwater. And then, like I showed earlier, it'll zag at one point and and then all of a sudden your P&L goes on that trade will go up to 45 to 75%, and then you can you did hear me say that, yeah, you can take that profit at that point. So yeah, but what you'll notice here is that his positions are not over 50% P&L, and that's because he took the profits on those. So there were more. There are more positions in here. Now, I'm sure Randy is running into the same, you know, capital management problems that I am, which is that we need more positions. I'm in SMCI too, yeah. But yeah, I don't know if you sold. Maybe these are ones you sold, tossed, and all these ones that say 0%, you made money on, but you sold them on accelerated gains, possibly. Yeah, that could be the case. Um, but yeah, I'm still in some of those. But yeah, it becomes the problem becomes finding more opportunities to get into. And but frankly, Randy, and you haven't experienced this yet because you're not using real money. But frankly, it becomes very rewarding. So when you start to use real money, eh, the enjoyment level will go up. It'll match, like the rewards will create enjoyment. Man, I've got you guys really fired up for the 50 position thing because Ben was like, fucking goal, 50 positions. And now Colby just said, Monday's goal, 50 positions. Become an athlete, fucking go for it. Yeah, that's awesome. I don't know what I said tonight, but I definitely I got the point across. Good to go, 50 positions. It trains you faster. You're going to get to the 6 or 8 month point in a month or 2 months. Yeah, that's fun. You can make more mistakes faster. The whole thing. It's all going to work out. So that's pretty. So, Randy, did I finish? Do you think? Did you add explanation there on that? Do you think now you understand the difference there between return on capital and max profit? Did I do it, or did I miss a subtlety of how you were thinking about those two things? Still, I might have. So I definitely said these things and started to get you to think about that. Because and well, maybe it requires me also just looking at some of the option chain, but okay, to $5 spreads. No, 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 you can't do that. But I will say that as you have more money and your sizes are very big, that getting $1 spread, so $20 for $80 of capital on a $1 spread would be $100, but with a $20 credit, it makes it $80 that's required. So it's $20 max profit for $80 max loss or capital required. Um, when you have that situation and you have to do a $2,000 allocation and it's $80 per contract, $2,000 times 8 divided by 80, that's 25 uh, put credit spreads. And that's buy and sell. So 50. So that's 50 times 65 cents each. That's $32.50. Just now, remember this, just to open the trade. When you close the trade, it's $32.50 again. So if you're getting 25 of these things and you're going to get $20 from each of them, you're going to make $500. but you're going to be paying $65, 32.50 to open and 32.50 to close. $65, you're going to be paying $65 to make that 500. So you're actually only going to make 435. And that's on somehow I think we said $2,000 credit, but $2,000. So that it really cuts into your return because now instead of now you're making a 21.75% ROC because of the fees instead of a 25% ROC. And 0.2175 divided by 0.25. And that is a, can you get that number, computer? Dickhead. His computer is really weird with that. That is a 13% fee in fees. 13% of your profits gone in fees. And that can be mitigated. So when you find something that has deltas that skip um not too much, so it goes like 19 delta, 21, 23, 24, 26, stuff like that, versus sometimes you go to something and it skips, it has like 18 delta, 26% delta, 38, the jumps are too big. So long as the jumps are small, you should be able to, and you'd have to check the liquidity on the specifics of it, okay? But you should be able to, instead of getting a $1 spread, you can get a $2 spread. So I do that all the time. And that cuts the fees down in half. But you have to double check the ROC calculation. It does suffer a little bit, but sometimes it doesn't. Sometimes the same. You're like, oh wow, I'm getting the same return even for a $2 spread. That's great. It's a very robust option chain. The liquidity is very good. Or maybe you can even go 3 or 4 or $5 spread. But at that point, you're not just going to the next open strike to buy back, that one and create the spread. You're going several strikes down and you're creating a wider wing artificially. Do you understand? So that's a technique to where you can decrease the amount of fees that you're paying. And it also has a positive effect on the um, Greeks. The Greeks become a little bit more favorable, and the trade will be, I've estimated, between 10 and 15% less whiplashy, let's say. Randy, would you say that sometimes, there's whiplash on these trades? Yes, I would definitely say so. Um, Whiplash exists. These trades move as much as the stocks move sometimes. And it's just that after a course of several days, you start to get the benefits of the theta calculating in. But during the day or day by day, the moves tend to be just as strong as the stock is moving itself. So there's a lot of whiplash. Well, what I'm saying is that when you widen the wing, you get a softer um, effect across all the Greeks that will be causing those whiplashes, and you get about a 10 or a 15% reduction in whiplash. It's not a huge amount, but it exists and it makes a difference. So that's an extra benefit as well. There was something else I was going to say. Oh, yes. Once you really got this flying and you have a decent sized account, maybe 10,000, 20,000, 50,000, or 100,000 or more, and you need to be doing lots of contracts, you should maybe switch over to Tasty Trade because Tasty Trade has the most amazing deal on contract fees out there. And there's something to the effect of a little bit more than everywhere else, 65 cents, a little bit more than everyone else for the first few options, but then they don't charge you any more after a certain number of contracts. So let me look at the Tasty Trade fee schedule. I don't know if they call it that. Commissions, fees, and margins rates. Okay, look at this. I'm going to pull it up and pull it over here. Okay, in case you're zoomed up, I put it on the right side of my screen. Commissions, $1. Oh, here's pretty cool. Look at this. $1 to open the contract, free to close. So that already cuts it in half and makes it basically 50 cents instead of 65 cents. So it's actually more to open it. But I think what they're saying is that if they were to expire like that doesn't compete. If somebody was trading style was such that every time they got into a position, they let it expire instead of closing it out, then they might say, ah, fuck that. That's too expensive. I'm getting 65 cents, over at TD Ameritrade, wherever it is. I only pay 65 cents. Why would I pay $1 a contract to open? See, that person doesn't have any fees when they close their positions because they always let it expire. Whereas we almost are always closing our positions early and not letting them expire. And so the fact that they have free commissions to close makes it so that that dollar to open is more like 50 cents to open and 50 cents to close. So that actually is competitive with TD Ameritrade and it is better and you're saving money. You're saving something, you're saving 25% or something on your fees. And then also, let's see, pretty sure there was beyond a certain, this might be a new, beyond a certain, here we go, closing commission zero, $10 max per leg. So in other words, look at that, $10 max per leg. So if you were to get 20 contracts, they would only charge you with $10 per leg instead of 20 or 100, which like, if you have a 200 or $500,000 account, you might need to be getting large gobs of contracts, even with wide wings. And they'd only charge you $10 to open 100 contracts instead of $65 or whatever it would be, so $100 for at $1 a contract, only $10. So Tasty Trade has really, really great pricing. And Tasty Trade is designed for options traders. It's by the way, it's made by the same guy that made Thinkorswim. So it's pretty awesome. So it'll be fairly easy for you to ever switch over to Tasty Trade. But I still don't recommend it yet because it's a little bit focused towards the option trading thing and really different. So you're gonna really like it's gonna take some adjustment. It's gonna take several months to get used to Tasty Trade. So don't just go like, I should probably just start learning that too and get used to that. This is like worrying about fucking taxes or something. Look, if you're making money, pay your taxes. Look, you don't have to worry about this shit for a year. Like, make money for a year and Thinkorswim, prove it, then you can go to Tasty Trade. So like, yeah, don't worry about that. Capped commissions. So it says, yeah, if you have 20 puts and calls, single leg, it'll only cost $10. Yeah, that's great. 20 verticals will be $20 because there's two legs in a vertical. But if you did 100 verticals, it would still be $20 because that's a capped commission. If you did that's pretty incredible. So Tasty Trade, pretty cool. All right, the other thing I wanted to talk about and for you guys to learn. What time is it here? 11:10. Yeah. So one last thing to learn, but does that clear it up? Yes, I get it. Okay, I think you said yes, I get it. I'm also limiting all fees to $5. $500 times 20 equals 10K. Yeah, well, it's not going to work out that way. You're not going to be able to pick and choose like that. You're going to have to be open minded. You're not going to, oh, it's not a $5 spread, so I'm not going to get that one. And it's a fucking beautiful setup. And all you need to do is to get like, four contracts on a $2 spread or something to get it to $440 or whatever. You'll see. Yeah, I mean, you just can't think that way though. Like, you can't just do all $5 spreads. You can't pick and choose. Like the stocks may not have it that way. In fact, 43 days out to expiration. Look, on this one, what is this? Caterpillar. 43 days out to expiration, it goes by fives because Caterpillar is a $400 stock, or I don't know what the fuck it is, $350 stock. But look here on the 17th of May, 8 days to expiration. It's at 310, 312.5, 315, 345. It's by $2.50 per strikes. So there's no way in holy hell you're going to be able to pick and choose because even on the ones that are $5, it'll drop down to a $1, $2.5 spreads. And then other ones will sometimes at 45 days for expiration will start at $10 spreads, which might be even too wide for you. And yet a little bit earlier, all of a sudden they introduce $5 strikes. And then as it gets closer to expiring, now they're down to 2.5s. And every stock you go to is going to be different. Like if I go to Apple, it's a $187 stock. Let's get rid of all that stuff. It's a $185 stock. And I'm not sure, but I can almost guarantee you that it's not using $5 spreads. So I go in here, 21. Oh, it is. Okay, but that's still fucking stupid. It was not, that doesn't, it's not explaining my point well. If you go to 8 days to expiration, it's already to $2.50 increments, but something a little bit more borderline. Let's see. Dell. This one probably makes sense. Go over to Dell. And look, I've had three put credit spreads on Dell already in the last like 2 months. Like you definitely do not want to not open a put credit spread on Dell. It's really good. It keeps going up. It looks great for a descending break even line type trade. Now we go over there and we go into the options chain, and those are by 2.5s. And then it goes by fives, proving my point wrong. But and then when it gets closer to expiration, it's by dollars. It's $1 increments. Tick, 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 tick. And your chain, as it gets closer to expiration, is going to have introduced intermediate increments the closer it gets to expiration. So you're not going to be able to pick and choose like that. Okay. Yeah, you can't say something like that. That's That would be really interesting to come across a guy who's like on Twitter or something. He's like, I only trade $5 spreads, period. Like, I would know immediately that guy doesn't know what the fuck he's doing. It's like, you just can't control that. It's just not something we can control. A chart's a chart. Oh, a wing is a wing. A spread is size, So anyway, uh, look, my allocation is $1,400. That's what I need to allocate every time I locate. I think it's like 1,430 or 1,470, something like that. My pinpoint accurate like allocation I'm trying to allocate per position is $1,430, right? Dude, I have some positions that are like 1,150, other ones that are like 1,580. Sometimes I'll get into one that's a $10 spread and I'm getting 180 bucks in credit. And so that means I need to put down $820, but I need a 1430 allocation. So what am I going to do? Should I get the 800 and what did I say? 820 one contract one, or should I get the 1640? I think 1640 is closer to the 1430, so I get the 1640. So I get two contracts. You can't control these things, but it's like the law of averages again. With the law of large numbers. If you just scatter plot like all this shit, that and you keep making it's like rounding, right? If you're always rounding properly, then in the end, in the long run, you're going to always have, gotten for the middle for the, what you were supposed to be trying for. It's gonna work out that way. It's gonna average out. Okay. uh, but don't, also, but on the flip side of that, don't get too extra excited about the fact that something is a $5 spread. I would try to tell you to try not to put any weight on whether it's a 5 or a 2.5 or a 10 or a 1 or a 50 or a 25 cent, 50 cents or a 25 cent. Uh, like just approach it plain and simple. Just check the chain, start where you can start, see how it matches up and fits, see if you can get it to fit. What can you do to make it fit? Can it fit? And then get it. Like I wouldn't get because I wouldn't want you to extra especially put yourself into something that was, maybe not ideal just because it had a $5 spread and the liquidity was there and a whole bunch of other stuff. But like, yeah, let me give it a shot. Watch out. Don't let that guide you in any way. It's not something that should push your decision. It simply is or is not. There is no try. Whatever. All right. And the other thing I wanted to talk about really quickly was called probability of touch. So, interesting fact is that, okay, let's see if you guys can answer this question. Maybe even Ben gets this. You've been attending some of these spread things. Who remembers? So, if something is 20 delta, what is the probability of price expiring at that level if it's a put or below, or if it's a call or above by expiration? What is the probability in percent on a 20 delta? I guess I I guess I said that wrong. It is 80% for us because we're selling it to other people. You're right. But a 20 delta, what is the probability of the price of the stock expiring below a 20 delta put by expiration? What is the probability of that price moving down and below that 20 delta strike that you got by its expiration? Price per probability percent. 20%. Right. Yeah. And that's clearly what I asked. Why did you both say 80%? It is 80% for us to win if we sell that to somebody. Why? Because it's only a 20% chance of happening for that person. Does that make sense? So it's 80% for us to win because we sold the option. When we sell the option, yeah, we're taking the other side of the trade. Yeah, we're always thinking of winning. Randy said almost the same thing. That's funny. You guys are really in sync tonight. So that's called that's how the delta kind of represents the probability. And it's not exactly accurate. There's some other factors, especially if things expire also inside of your spread, which can happen. Right, that's a probability. There's a probability of that happening. And so it kind of erodes that probability a little bit, but it's a good rule of thumb, okay? So, and it's pretty close as it turns out. It's like 19.2 or whatever. But it's like 20% probability that it's going to expire at the very end where the price is below that strike. Okay. But here's an interesting thing. There's just there's also the statistic, which sometimes you might want to be concerned about, of what is the probability that price zigzags and touches my strike level before expiration. New Angle says 100%. Seems like it, right? No, if you start to do law of large numbers on these and you do a lot of trades, you'll notice it's not all the time. But it seems like it would be, right? It's like it always goes against you. No, you'll see it's not too bad. It turns out it's double. It's double the delta. That's a very cool rule of thumb. So if there's a 20% probability of price getting down to the strike by expiration, there's a 40% chance, double it. There's a 40% chance that price is going to get down there at all at some point. 40%. So that's why, Randy had showed me some of his positions on his spreadsheet or whatever, and he had one that was at a 40 delta, or it was a very high, let's just call it 37 delta. Okay. I don't know. Well, probably wasn't that. Maybe it was 27 delta. But let's call it, actually, that's a good, maybe like 37 delta. Let's just call it that, 37. So it's a 37% chance of expiring. Prices has a 37% chance of getting down there and expiring below that put and causing you not to win, right? So it's a 63% chance to win. But the probability of it actually getting down there before expiration, and we sell at 21 days to expiration anyway, so this is kind of a concerning thing that we have to think about, is double that percent. So if you're at a 37 delta, you have a 70, what is 37 times 2? 74% chance that price is going to get down there. Isn't that crazy? So if you go for a 37 delta, there's a 74% chance that at some point price is going to get down there. And you know when it gets down there, it's going to be bouncing around and it's going to test your faith and it's going to be down in there, pushing around. And so probability of touch doesn't, you know, transpire as just a little boop and then it goes the other way. Uh, tends to mean like, it's happening and then it could go for a while and then but by expiration it gets out of there, right? So but in between uh it touched it. So that's important to note because when you can look at some stocks that you might want to be getting into, if you look at their support and resistance areas, like that one I was looking at was in Microsoft, for example, or Google. Let's see, Google, or let's see, even Microsoft was even crazier. Uh, yeah. So this is interesting, but we know that there's a 20% chance of price being above this level by this date. There's a 20% chance of price being at that level by that date. However, there's a 40% chance that before that date, price will get above that level. Might come back down, but it will be up there. And so if you're like on the fence about a particular delta. Maybe you have to choose a different skip, like perhaps it's a 19 delta, and then the next one up is 26, or let's say it's 17 delta on one strike, and the next strike, the neighboring strike you have to choose is 26. And you're like, well, I mean, let me check the ROC. And the ROC checks out, you're going to get 33% return on this trade. It's like, great, right? You got 33% ROC on a 26 delta. And you're like, okay, I've been said never go above 27. And you were ideally, we want 20, but here we go. Here we are on this. And I looked at the strike levels and they look, like decent levels and everything. But realize that when you get that 26 delta, you have a 52% chance. A coin flip, more it's better than a coin flip's chance that price is going to get up there and breach your strike. And if it's going to get up there and breach your strike, there's a decent chance that it's going to stay up there for a little bit while, and that's also going to mean that you're going to have to exit your trade. So you're kind of get yourself into trouble as you venture away from the 20 delta because of the probability of touch situation, that whole situation. And so that also goes towards why we gravitate more towards a 20 delta than anything higher when we're putting on these trades. And do you guys remember this might have been in like January, where I had run some mathematical calculations and figured out that there's no difference in return for the same amount of risk. You'd be risking more for the same return once you pass 27 delta. Well, that's the case. I think it's either 27 or 29. Let's call it 27 just to be safe. Um, well, that just goes to show that no matter what system you choose, probability wise, especially with probability of touch doubling in between that time and having a system of closing trades before expiration, where things could definitely touch and breach, staying on the erring on the 20, the lower side of the 20 delta is a good practice. Does that make sense, guys? Yeah. So once you understand all that, it starts to make sense. And that's also why today I put on an 18 delta trade because I could have chose the 21, but I said I looked at what is the 18 paying? The 18 was paying 21.5% return on capital. And so I thought to myself, look, I'm still getting a great return, but why not increase my probability of winning? I mean, why not? Sometimes here and there, if I had to choose, sometimes between these different things, why the hell not? Because I think it was like a marginal, like if I did choose that 20 the higher delta, whatever it was, 21, I don't know, it might have been 22. The next neighboring strike might have been 22 delta. If I did choose that, it was like a situation where it wasn't quite below the pivot of support, on a chart like down here, and it was more like cutting into it. Maybe it was the 400, for example, in this chart. And I just felt like, hey, what am I doing? Like, why subject myself to that much chance? Why not, just make a little bit less money, but increase my probability by a whole ton in this situation, since I am concerned about the fact that price might not stop at that higher level. So I went and I got the 18 delta, which was like this lower level and much better. And to be honest, I think it was this one. I think it was Microsoft. It might have been this one. You've been running into this every day. Yeah, well, I mean, these are, some of the textured um, parts of being more experienced at this and gaining experience. It eventually it will become, what's the word, natural for you to understand that, even had I not taught it to you. If you were just doing all these over and over and over, and then you're like, let me try getting that, and it worked out, and little by little, you'd notice that the slight errors towards one direction or another would start to give you the results to guide you into better decision making towards those kinds of moving off the, you know, track. What do they say? Moving, venturing off of the, track to some slight adjustments here and there, and you would be rewarded or destroyed by the right and wrong decisions in that way. And just experience alone would just start to um, answer your own questions in that regard. But so yeah, I can definitely tell you that's the answer. That there are, look, there are people that take 5 delta, like they just never want to lose. There are people that take 5 delta trades because they want 95% to win. They never want to lose. They just want to just always win. Well, I find that 5 delta doesn't beat the stock market. So like 5 delta is just a little bit too low, but they like it because maybe that's just how they enjoy a defined risk trade system, and they just rinse and repeat it. They do the 5 delta, they get their probabilities, it works. They, cash their checks at the bank. You know what I'm saying? It works. But there are people that do 10 delta, and they're, from that point, usually people from there go to about 20. But a lot of people do too much. A lot of people do 25 or 30 delta, and even like 35 and 40 delta, and even 45 delta. These are just crazy uh you know um trades that won't hold up in the long run. uh, 25, not too bad, but still, really pushing your luck, especially with that probability of touch thinking. So cool. That's probability of touch. Interesting, right? You probably didn't know that. And an amazing thing is to look at stocks in a statistical and probability manner is really going to improve your trading and your ability to put on options trades. If you just trade vanilla options, you're going to start looking at the delta, and it's going to just change how you change your perspective and understanding of the whole thing, especially if you can do that, if you can make that line, whether you do a vanilla trade or you're selling an option, if you can just draw your break even line to expiration, even if you plan on selling beforehand, you can see, am I being ridiculous? And this is like a real long shot here, and maybe I shouldn't even do it, or what? And by the way, when you do something where 19 out of 20 times it doesn't work, but one time out of 20 times it works and you get a 20-to-1 return, it sounds like a good idea. In other words, it sounds like positive EV theoretically, because 19 out of 20 times it didn't work, but then that one time out of 20 it worked so much it paid maybe 25-to-1. So overall, now on 20 tries you got a 5-to-1 return on one of the size of that trade. It sounds good in practice, but the problem is that law of large numbers is that with a mouth open 19 out of 20 on the this trade is not going to work outside, in order for the one trade out of 20 to consistently make up for that wide of a negative mouth, it would take probably 20,000 trades before you could start to expect to see what you expected. And the problem with that is you'll be broke many times before you would ever get there. So that is one of the reasons why so many people lose money trading in the stock market is they're taking strategies where the lose rate is just too high compared to the win rate, even if the reward to risk ratio makes up for it, is because the law of large numbers, you're going to get that variance where you're going to get a bad run in there and you're going to get a very bad run and it's going to destroy your account every now and then. And you'll be climbing out of that hole and you'll finally get there and then you're going to destroy your account again. And you're going to find this impossibility happening where you just can't make progress. And that's a big part of it. Now, put credit put credit spread trading, the max profit system, um, takes the opposite side of all these trades. So, you're 80% plus to win and only 20% to lose. It's fucking amazing. So, I wish you all well in in executing it. But get executing, get it going. Uh, yesterday, you're gonna thank yourself later. All right, you guys, have a good night, and see you in the morning. We've got consumer sentiment coming out in the morning. We'll see what happens there. Thanks again for showing up. Appreciate you guys, and wishing you the best with all this. Bye bye now. Good night.